Hi, good morning, everyone. Thanks for joining us for our morning call. We have quite a few stock counter updates as well as our Singapore Banking Monthly and our Singapore Weekly. So without further ado, I'll start off with the Banking Monthly. Next slide, please. Okay, thanks. So for Banking Monthly, I'll just do a quick recap of the fourth quarter results. So for DBS, their full year 21 earnings of 6.8 billion met our estimates as higher fee income and strong loans growth offset lower NIMs. Their fourth quarter DPS rose 9% to 36 cents. For OCBC's full year 21 earnings of 4.86 billion met our estimates despite higher than expected allowances, which were offset by higher net interest income. The fourth quarter DPS rose 12% to 28 cents. And lastly, UOB's full year 21 earnings of 4.08 billion missed our estimates by 6%, mainly due to lower than expected trading and investment income. Their fourth quarter 21 DPS was stable at 60 cents. So for the main points, their NIMs, the bank's NIMs remained stable quarter on quarter, but it went down year on year, as seen from the table on the left. This was mainly due to lower market interest rates. However, their NII grew 5% year on year, mainly due to loan growth of about 9% year on year. And the banks have guided for stable NIMs for full year 22. They have also guided for loan growth of about mid to high single digit for full year 22. Their net fees and commissions for the banks continue to grow at about 8% year on year, and this is mainly driven by wealth management fees as investment and trade activities pick up. For their credit costs, it continues to moderate across the board, and full year 22 provision guidance for the banks have been lowered. So DBS's is the lowest at about 12 basis points, whereas OCBC and UOB are similar and they've guided for 20 to 25 basis points. So lastly, the CET1 ratio for the banks of 13.5 to 15.5% is above the operating range of 12.5 to 13.5%. So this would prompt active management of capital, and we could expect possible higher dividends. So next slide, please. So moving on to the interest rates. The interest rates were up slightly in February. The 3-month SOR was up 7 basis points month on month to 0.39%, while the 3-month SIBOR was up 1 basis point month on month to 0.45%. The 3-month SOR is 8 basis points higher than its fourth quarter 21 average of 0.31% and is improved by 18 basis points year on year. The 3-month SIBOR is 1 basis points higher than its fourth quarter average of 0.44% and is improved by 4 basis points year on year. Moving on to the next slide. So for Hong Kong's domestic loans, the growth fell by 6.79% year on year, but grew by 0.81% month on month in January. The year-on-year loans growth for January was the lowest recorded since 2010. However, the month-on-month loans growth for January was the highest since June 2021. For Malaysia's domestic loans growth, it saw an increase of 4.66% year-on-year in January and rose 0.53% month-on-month. The increase year-on-year was the highest recorded since March 2019. Now moving on. So the preliminary SDAV for February rose 20% year-on-year to 1,625 million as community COVID-19 cases rose. The VIX averaged 25.8 in February, up from 23.2 in the previous month. For the top 5 equity index futures, the turnover saw an increase of 4.6% year-on-year in February to 13.26 million contracts. This was mainly due to the higher trading volumes of its Nifty 50 index futures and the MSCI Singapore index futures. Notably, the Nifty 50 index futures increased 8.9% month on month to 2.6 million, and the FTSE China A50 index futures fell 17% month on month to 7.1 million. So next slide. Sorry, is it the next slide, the last slide really for me? Okay, thank you. So our investment action, we maintain overweight and remain positive on the banks. The bank dividend yields are attractive with upside surprise due to excess capital ratios. The improving economic conditions and rising interest rates remain tailwinds for the banking sector. So that's all I have for the banks. I'll now hand it over to Natalie.
Thank you, Glenn. Good morning, everyone. I'll be talking about CapitaLand Investment Limited's full year 2021 results. Just starting off with the table on the left-hand side, we see that revenue has actually grown by about 15%, and revenue comprises two main segments: real estate investment, which is the IP, as well as fee-related earnings. So fee-related earnings can be further broken down into four parts, which is the REITs, fees from REIT management, fees from PE fund management, fees from property management, as well as fees from lodging management. So across the board, we can see that most segments actually registered recovery in revenue, with more significant uptick from the REITs as well as the PE fund management, which grew by about 33% and 35 or 36% year on year. And this was largely due to the higher transaction-driven fees due to asset recycling, which prompted a 10% growth in FUM, funds under management. Lodging management also recovered significantly, 27% year on year, due to recovery in operations, as well as 8,200 new units turning operational. Okay. So in terms of PATMI, which comprises three main segments: operating PATMI, portfolio gains, and revaluation gains. Operational PATMI grew by 12%. This was due to higher fee income from the fund and lodging management, as well as improved operations from the IP. Portfolio gains, due to a very significant year of recycling, 13.6 billion in assets recycled in FY21, which is a bumper year for CLI. That actually resulted in $616 million in realized portfolio gains, of which the divestment of the partial stakes in 6 Raffles City China assets accounted for 44% of these portfolio gains. In terms of revaluation gains, CLI recorded a 236 million write back revaluation gains, and this is reflective of broad-based recovery in valuations. In terms of the positives, just to wrap things up in terms of the financials, so FY21 PATMI of $1.3 billion. This was 52% above our forecast due to higher than forecasted performance of JV and associates, as well as valuation recovery and portfolio gains. Okay. And also not to mention, CLI announced or proposed a dividend of 15 cents. This was a positive surprise, and it exceeded our DPS forecast of 8.3 cents. Yeah. So this 15 cents dividends, it comprises 12 cents of ordinary dividends and 3 cents of special dividends. Okay. In terms of the positives, FY21 was a stellar year of capital recycling, and this drove FY21 fee-related earnings by almost 33%, and the funds under management by 10%. So as I mentioned earlier, this was a bumper year of divestments, 13.6 billion divested in FY21, and this was at an average premium to book value of 13.1%. And this is even better than what CLI has achieved in the last 3 to 5 years, which has ranged between 8 to 10% above book value. Okay. 82% of the divestments were converted into FUM. This means that the assets were either divested to the REITs or to the private funds. Yeah. Okay. In terms of lodging management, lodging segment has recovered steadily. Revenue has improved by about 27%, and RevPAR rose by 19% year on year. And this is on the back of improved occupancy, which climbed from 50% to 60%, as well as higher average daily room rates. Not to mention, CLI beat CII signed a record number of 15,000 units, 15,000 keys in FY21. This is even better than the number of keys that were signed in FY20, which was so basically it's a new high. For China, operations in China continue to show recovery, while operations in Singapore are stabilizing. Occupancy across the retail, office, and new economy assets in China improved by 3 to 4 percentage points, while in Singapore, office and retail assets occupancy fluctuated between 1 to 2 percentage points year on year, as they were still impacted by tightened restrictions throughout the year. Yeah. In terms of the negatives, occupancy in India's business and logistics parks dipped by 8 percentage points year on year. So occupancy fell from 93% to 85%. And whilst India is presented as one of CLI's core markets, it only represents less than 3% of CLI's FY21 EBITDA. And so this is clearly an abnormally for CLI, because India is the only geography where the occupancy actually dipped for the new economy assets. In Singapore and in China, occupancy actually improved. So this was largely due to some non-renewals in the portfolio. Okay, in terms of outlook, CLI continues to recover on the back of reopening as well as return to normalcy. They maintain their 3 billion per annum divestment target, which will help to grow FUM by 10% per annum. And they are on track to hitting their 2023 lodging target of 160,000 keys under management, as well as 100 billion 2024 funds under management target. CLI is also targeting double-digit ROE in the near term. We maintain our accumulate recommendation with a sum of the parts target price raised from $4 to $4.05. We raised our FY22 investment management PATMI as we bake in faster FUM growth, as well as higher EBITDA from the lodging segment. And this target price of $4.05 represents a 13.8% upside, as well as a PE of 15.5 times. Now moving on to city developments, this is their full year 2021 results. We'll start off with the table on the left-hand side. Overall, revenue grew by 24%, or rather 25%, mainly due to higher revenue from the property development as well as the hotel segments. Gross profit also grew. However, gross profit margin compressed slightly from 39% to 37% due to thinner margins from the Singapore property development segment. In terms of breakdown of profit before tax, PBT, we see that the property development actually grew by 11.4% year on year. This is due to the timing of income recognition and boosted by negative goodwill of 26 million for the acquisition of Tasincia, as well as lower allowances. Hotel operations, while still negative at the profit before tax level, you can see that there has been a very strong recovery in terms of operations from hotels. It was actually negative 467 million in FY20. It improved to negative 71 million. So RevPAR grew by 49% year on year due to stronger recovery in the second half of the year, as well as 69 million in write-backs of impairments in FY21 versus 87 million of impairments recognized in FY20. Investment property profit before tax for investment property fell from 136 million to 24 million. This was due to lower divestment gains in FY21. Not to mention, 2 assets were also closed for a substantial part of the year. Jung Salon, which is a mall located in Phuket, as well as Fuji Xerox, which were closed in March of 2021, as well as the second half of 2021. Yeah. In terms of PATMI, CDL's PATMI has turned positive, recovering from the negative PATMI that was recognized in FY 2020. In terms of how it performed against our expectations, so the revenue of 2.6 billion actually formed 106% of our forecast, beating our forecast slightly. However, PATMI underperformed due to higher than expected taxes, which excluding which performance would have been in line. Now we move on to the positives. In terms of positives, this is the highest number of residential sales recognized in FY21 over the last 10 years. So CLI sold 2,185 units. This was 66% higher year on year. And the total sales value came in at about 4.3 billion Singapore dollars. And this is 131% higher year on year. Okay. And the 2,185 units that were sold in 2021 actually surpassed our own expectations of 1.6 thousand units that forecasted for FY21. This was attributed to stronger take-up at two projects, namely Irwell Hill Residence as well as Canning Hill Piers, which were launched in FY21. Okay. However, as mentioned earlier, the profit before tax margin for the development segment has compressed slightly from 23% to 22%. The second positive would be the hotel segment, which has turned EBITDA positive. So revenue jumped by 49% year on year, with significant pickup observed in 2Q and 3Q of 2021. Occupancy improved year on year from 38.6% to 51%, with gross operating margin widening from 3.7% to 21.8%. However, do note that there's still more room for improvement. We compare FY29 gross operating margin, which actually which stood at 39%, so there's still a little bit more room for recovery. The hospitality EBITDA is still 40% below 2019 levels. The third positive would be the opportunistic divestment of Millennial Hilton's Seoul, as well as Tanglin Shopping Centre. So for Millennial Hilton Seoul, there will be about 528 million in divestment gains that will be booked in FY22. So this sale actually, the SMP was actually signed in 2021, but due to the timing of the closure of the sale, the divestment gains will be booked in FY22. Similarly, for Tanglin Shopping Centre, CDL actually put this is a strata asset, so it was actually put up for bidding in December of 2021, but the sale will be completed in FY22. Currently, the amount of divestment gains expected from Tanglin Shopping Centre is expected to be significant because CDL has been holding this asset on their books since 1981, and the book value has been significantly depreciated. However, CDL hasn't provided a guidance for how much divestment gains will be booked as of yet. In terms of negatives, the listing of the UK commercial REIT that was delayed was a clear negative for us. However, occupancy for the two assets that will be injected into the REIT, this is namely 125 Old Broad Street as well as Aldgate House. These two assets, the occupancy has improved, and this will of course strengthen the initial portfolio for the REIT. And just as a refresher, based on our previous forecast, assuming a 20 to 25% stake for CDL and the injection of these two assets into a 38% geared S-REIT portfolio, this could unlock about 500 to 600 in capital for the group. In terms of outlook, healthy inventory levels allow for more conservative bidding for CDL. During the year, they actually picked up two new sites. So one of them was Upper Bukit Timah Road, which was purchased in an off-market deal, and another site was the Jalan Tembusu Government Land Sale, GLS. So these two sites will add about 1,000 over units to the pipeline, bringing the number of unsold units for CDL to 3,047 units as of 31st December. Yeah, so with this substantial pipeline of unsold units, CDL can afford to be less aggressive when it comes to bidding for new land sales. Yeah. CDL is also unlocking value through strategic redevelopments. So recall earlier that Fuji Xerox, which is one of the office assets in the CBD area, they are undergoing redevelopment. So CDL will also be undertaking another redevelopment for Central Mall, and they will be taking advantage of the URA's strategic development initiative scheme to undertake this redevelopment, and that will result in a 67% GFA uplift. So in conjunction with this, Central Mall is an asset that is owned by CDL. They have purchased an adjacent site, which is Central Square, from FEHT, Far East Hospitality Trust. So these two plots will be undergoing this redevelopment. Another asset that might potentially benefit from GFA uplift would be City House. So City House is an office asset that's located in the CBD area along Robinson Road and Cross Street. And it also falls under the CBD incentive scheme. So while there has been no finalized plans for redevelopment, the management is reviewing the merits of undertaking a redevelopment, but no plans as of yet. The last point I want to highlight is the distribution in species. So for CDL, they actually announced a dividend per share of 31 cents. This comprises 12 cents in cash, as well as a surprise distribution in species of CDL Hospitality Trust, which has been valued at 19.1 cents. Okay, so this distribution in species, it will result in a deconsolidation of CDLHT from CDL's books, and CDL's stake in CDLHT will be reduced from 38.7% to 27%. And this deconsolidation will actually result in an estimated accounting gain of about $467 million. And it will improve gearing from 61% to 55% on a pro forma basis. So one of the benefits, or one of the alluded benefits of this deconsolidation is that it will allow CDL to recognize any gains on future sale of assets to CDLHT should the transaction value exceed the carrying book value. Because initially it was being consolidated, so there will be no gains recorded. Whereas when it's deconsolidated, you can actually see the gains being recorded. Okay, so yeah. And also the benefit to the shareholders would be, it will allow unitholders to benefit from the recovery of the hospitality sector. And this DIS distribution in species will be subject to unitholder approval held during the AGM. Overall, we maintain our buy recommendation with a NAV target price of $9.19. CDL, in our view, is a proxy for the Singapore residential market, as well as the hospitality recovery play. And while land prices have trended upwards in the recent years, redevelopment and off-market purchases should provide better margins, allowing CDL to replenish its inventory and participate in the peaking Singapore residential market. CDL is trading at an attractive 48% discount to our RNAV per share of $14.14. And also asset monetization and unlocking value through AEIs and redevelopments, as well as faster than expected recovery in the hospitality portfolio, are potential catalysts for CDL, which could help narrow the discount between CDL's share price and NAV. So that brings me to the end of CDL, and now I'll pass the time over to Terence for Pan United.
Yeah, thanks, Natalie. We cover Pan United's full year 21 results and second half 21 results announcement in our next slide. Second half 21 revenue grew 45% as the construction activities in Singapore continue to recover. If you look at the table here on your left-hand side, you can see on a year-on-year basis, second half 21 revenue grew 45%, and this was driven by the recovery of the construction activities in Singapore, which pushed concrete and cement up. This beat our expectations. Gross profit was also up about 40% on a year-on-year basis. The compression in GP margins was because raw materials actually rose at a faster clip than selling price. We'll talk more about the gross profit margin later. In terms of NOPAT, even though they saw a lower income from the support from the government, the higher revenue still push NOPAT up. In terms of the positives, second half 21 revenue and profits beat our expectations. The beat was driven by the faster pace of recovery in the construction sector. Net gearing was 22% lower than our forecast as well. This was driven by the better results and improving free cash flow, which they used to repay the loans that the group owes. For full year 21, dividend per share came in at 0.6 cents higher than our expectations, bringing full year dividend to 1.6 cents. This represents a 60% payout. We note that the 60% payout is higher than the company's stated dividend policy of 30%. And this, in our view, signals the group's confidence in their mid and long-term outlook. In terms of the negatives in our next slide. Yeah, thank you. The manpower shortages, supply chain disruptions, and volatile freight costs impacted GP margins. To be clear, the Pan United can pass on these cost increases to their customers, but sometimes there's a time lag, and this time lag can result in them delay a lag in the time that they pass on these costs to the customers, and that's why we see the GP margins compressing. For 2022, we continue to expect ASPs to be higher because of demand in the region. So we don't see ASPs decreasing, and this will have a near-term impact on their overall margins, at least in the near term. In terms of outlook, the Building and Construction Authority has upgraded the forecast of the construction demand for 2022 to 27 to 32 billion from the original 25 to 32 billion dollars. So you can see what they did is they tightened the forecast from the original 25 to 27 to 32 billion dollars. The demand for ready-mix concrete or RMC is also already back at pre-COVID levels. If you look at the chart here on your left-hand side, thank you, you can see that the ready-mix concrete is already back at 2019 levels, and our forecast for 2022, we expect this to continue to increase at about 15 to 20%. In light of this, we raised full year 2022 earnings by 11% on account of the higher demand brought about by the construction recovery. Our target price is raised to 46 cents from 44 cents previously, and we arrived at the 46 cents by pegging this to 16 times its full year 22 PE. So 16 times full year 22 PE is actually a 15% discount to its 10-year historical average PE on account of the still uncertain environment. So that's all from me for PenU. I'll now hand over the time to Ambrish for Adobe.
Thanks, Terence. Good morning, everyone. I'm Ambrish Shah, part of Phillip Securities research team, and I'm based out in India. So the team has initiated coverage on Adobe. We believe the company will continue to benefit from the digitization of businesses worldwide. Next slide, please. So talking about moving on to the company's background, Adobe is one of the largest cloud-based software companies in the world. It provides solutions for creation and publication of a wide range of digital media content. The company's business operating segments are divided into three parts. The primary digital media segment, it contributed about 73% of overall revenue in FY21, and it includes Creative Cloud and Document Cloud businesses. Creative Cloud, it mainly is for creating and delivering compelling digital media content. And the main products under this particular category are Photoshop and Illustrator. Meanwhile, Document Cloud provides solutions for creating, editing, and e-signing documents digitally. And it includes Acrobat PDF and Adobe Sign. The second segment is digital experience, and it includes artificial intelligence powered software for analytics, marketing, and commerce. And the last segment is the publishing and advertising segment, and this is the legacy part of Adobe's business, and it contributes about 2 to 3% of overall revenue. Talking about the revenue, Adobe generates more than half of its revenue from the Americas market, and it contributed about $9 billion in FY21. About 27% of revenue came from Europe, Middle East, and Africa, and the remaining 16% from Asia Pacific. In FY21, the revenue rose year over year about 23% to $15.8 billion. And the revenue growth was mainly because of the explosion of digital content. Next slide, please. So our investment thesis is, the first one is digital content creation and consumption across devices is increasing. Adobe is well positioned, and Creative Cloud software suite, it mainly caters to the growing demand from media and design professionals, communicators, and students. Creative Cloud is the core of Adobe's business operations, and it has consistently accounted for about 60% of revenue over the last 3 years. In FY21, Creative Cloud revenue came in at about $9.5 billion, which was up about 23% year over year, and we have modeled 13% growth in FY 2022. The company's management expects that Creative Cloud total addressable market is expected to reach $63 billion by 2024. And the main drivers for this expected growth are growing demand for content creation by consumers on social media platforms like Facebook and TikTok, digital transformations as the companies, they move from paper to an digital media, so which was fueled by the COVID-19 pandemic overnight. Then there was expansion of non-professional creatives, upskilling, and higher individual usage, mainly by the rise of mobile phones. Next slide, please. Previous one. Yeah. Our second thesis is Adobe is a strong player in digital signatures. The pandemic has provided a boost to the digital signature industry and cloud document management. And the company is likely to benefit as workflows shift from paper to digital. And due to this, there has been an increased digitization, which will result in more PDFs being generated and automation, which will benefit Adobe Sign. So the cloud business momentum was strong in FY21 with more than 100% year-over-year growth of Acrobat Web monthly active users and more than 85% year-over-year growth in Adobe Sign transactions. In FY21, document cloud revenue came in at about $2 billion, up about 32% on a year-over-year basis, and we have modeled 19% growth rate in FY2022. Next slide, please. So third thesis is Adobe generates incredible margins. Adobe generates most of its revenue based on subscriptions, and it makes up about 92% of Adobe's total revenue in FY21. So the subscription-based business model, it leads to the impressive gross margin of about 88% constant. It has been about 86 to 88%, and this is mainly because the company has a low cost of revenue expense. The operating margin has also expanded to 37% in FY21 from about 29%, as a lot of new customers have signed up for Adobe's products. In FY21, Adobe has produced $6.9 billion in free cash flow, which translates to about 44% of FCF margin. And this significant amount of free cash flow helps Adobe to acquire other firms such as Frame.io and Workfront and return cash to shareholders via buyback. Lastly, Adobe doesn't rely on debt for its business operations, and as a result, the company is less vulnerable to rising interest rates. So that's all for our investment thesis. Next slide, please. We have valued Adobe a target price of $658 and per share, and this is based on a DCF valuation using a 6.2% WACC and 4% terminal growth rate. I would now like to pass on to Paul for Singapore Weekly and other updates. Thank you.
Okay, thanks, Ambrish. We move on to Asian Pay TV Television Trust fourth quarter 21 results. Just a refresh. Asian Pay TV is an operator of cable TV and also broadband in Taiwan. Our title suggests 7% yield. This talk is all about the yield for now. So we think that the 7% dividend yield that is and dividends are paid quarterly is well supported by cash flows. Next slide. In terms of the results met our expectations. I think EBITDA was basically in line with our full year forecast, and their quarterly dividend of 0.25 cents is maintained. In terms of the positives, the main positive has been the broadband. So if you look at the table on the left, broadband revenue was up 19%. Probably the broadband growth only happened the last probably 18 months. So what has happened is that not only did ARPU rise, but also the subscriber numbers expanded. As you can see, our subscribers was up almost 13%. One of the reasons is because customers are moving up to the higher bandwidth plans, up to 300 megabits, and also they're working closer with the mobile operators. So the mobile operators are selling their broadband plans because these mobile operators don't have a broadband; they are pure mobile operators. So in their shops, if you walk into this mobile operator shops, they now can also subscribe to fixed line broadband plans sold by APTT. The other positive was free cash flow. This is an important metric because it will determine whether they can cover the dividends. So if you look on the table on the left, the free cash flow is about 24 million, that more than enough to support the quarterly dividend of minus 4.5 million. The negative for us was interest rates. I guess not only just them, I think all companies will face this. So they have onshore Taiwan debt of 1.3 billion that will expire in, the hedges will expire in end of last year. So they're going to lock in new rates, and we are assuming that there will be higher interest expense because of this. We will roughly maybe 2 to 3 million extra. In terms of outlook, the growth in mobile is replacing the weakness in cable TV. So you can see on the top, basic cable TV is down 4.4%. The upside catalyst will be maiden revenue from 5G, which they say will be material, but they haven't really given much visibility, and they just said that it's 2 to 3 years. It's hard to forecast these numbers because there's very little operating metrics, very little data that is given us, but they just said that it's going to be material. But we haven't factored any of this yet, but this will be the upside surprise or optionality. We maintain our accumulated and unchanged target price. Next slide. Q&M Dental results, fourth quarter. So the results was, for us, the highlight has always been their record expansion of clinics. But right now, the COVID-19 PCR test revenue will become less relevant because PCR is hardly going to be everyone can opt for ART now. Next slide. In terms of the results was below expectations. What declined dramatically was the COVID-19 PCR test. So to give you a flavor, because their COVID-19 PCR test is through this company called Acumen, which they own 41%. So the remaining 49% profit will be recorded as minority interest. So you can see at the table on the left, minority interest in the fourth quarter 21 was only 778,000. This is a huge decline from the third quarter where the minority interest was almost 4 million. So you can see the 4 million dropped to almost only 800,000. So it's a huge decline because the need for PCR is no longer there. In the past, especially those in the construction industry, virtually had to do PCR tests every 2 weeks, and this can all now be done in ART. So this is one of the ways that they lost revenue. The positive for us was the record expansion in clinics. So they opened 7 new clinics in Singapore. So this is meaningful. It looks like only 7, but the highest number of clinics that they opened was in 2019, which is the whole of 2019, they opened only 7 clinics. So right now they do it in 1 quarter. The negatives was the profitability. The revenue from dental was actually up 7%, but it was put down by higher provision of bonuses. In part, I think they should have done it more proportionally and rather than make it so lumpy. But anyway, the other dip was, like we mentioned earlier, the decline in Acumen, which collapsed from 4.4 to around 4.4, sorry, to not 3.7, 4.4 to 0.8. Sorry, there's a typo there. ART has been a default option, but now most actually using, ART has now become the default option rather than PCR. In terms of the outlook, we think there will still be revenue growth in 2022, mainly driven, at least for the dental part, mainly driven by the clinics. They've opened 18 new clinics in 2021. So this will contribute to full year revenue in 2022. And also they'll be opening they plan to open another 30 clinics from 2021 onwards over the next 10 years. For Acumen, sorry to jump around, but for Acumen, they will still contribute, but it will be from the 46 Q&M dental clinics that provide ART testing, that means supervised testing services. So in terms of the expansion, sorry to jump in. So what it means that if they were to proceed with the 30 clinics, we are looking at a doubling of dental clinics over the next 5 years from last year. So we maintain a buy, but we kind of lowered our target price because we are cutting our profit by 15% due to lower PCR revenue. We still maintain a buy and our target price is 71. What we do is we take 25 times PE from the core dental. Then we take in their associate, which they have a stake in Alcin Q&M Dental. Then we take in 20% discount. Then we also have some valuation for Acumen, but we cut it down dramatically. Since our valuation for Acumen is only like 15 15 million in our target price. So most of it comes from the dental operations. Next slide. Next. Okay, if you go to the previous slide. Okay, if you go to our usual weekly, let's give an update on Singapore macro. Also, construction activity is still healthy. I think in January, it was up year on year to around 2.4 billion. But it's higher than the prior month, December. So these are construction awards by the public sector and private sector. So this is still within the BCA forecast of about 27 to 32 billion. So it will be another strong year in construction activity in 2022. In terms of the rail traffic, so this is an important metric because of Comfort Delgro. So this is all the rail travel within SBS Transit, which is owned by Comfort. So the numbers hasn't been good. It was down 8% in February, but because there are festive periods involved. So even if you combine Jan and Feb, it's still down about 4%. And if you compare to pre-pandemic, rail traffic is still 33% below pre-pandemic levels. These are all the lines operated by SBS, not SMRT. In terms of the FX reserve for Singapore, it was still remains robust. So Singapore's FX reserve is almost 426 billion, which is a record, and it was up about 8 billion, higher than the January inflows. I think the benefit for Singapore now is, of course, we're probably getting that safe haven flow or safe haven bid in terms of liquidity. CPI, I think we all know this is a 40-year high in US. The other interesting thing for us was the ECB meeting. So we thought they would stay a bit more dovish, but actually they turned a bit more hawkish and looking to unwind their version of QE. So they're going to stop net purchases of government bonds by the ECB by the third quarter, because they still think that Europe will grow. Their GDP forecast for Europe is still very healthy at 3.7%, even though the Ukraine conflict. So in terms of our tactical views, we are still playing the interest rate cycle. We think it's still intact. That means interest rates will continue to climb. It's actually in the US, it's already hitting almost 2% for the 10-year bond yield. And even the ECB is also raising rates, and the market is already pricing in ECB to raise rates by the end of this year, likely in the fourth quarter. The other team we like is still the recovery team, which I think, as you know, the authorities lifted up some restrictions, very minor, but what the authorities highlighted that is in 3 to 4 weeks, if cases come down, you can expect significant easing of restrictions. So our base case is more like a base guess rather than a base case, but our base guess is that in terms of the Ukraine conflict, I think this thing won't stop until he takes Kiev and removes Zelensky. Again, this is very difficult or almost impossible to kind of try and second guess what Putin or try to outgame what Putin's going to do. But again, this is just our own base case or base guess what might happen. In terms of the key events for this week, it will be the FOMC meeting. Expectations are 25 basis point hike. So the view of the Fed right now is the Fed is probably going to raise maybe 25 basis point and do the usual speech to say that we will be monitoring the inflation. We will also be careful of whether the economic growth was slow, but they will just keep on doing this. They will probably just raise 4 times and have the usual spin that they're monitoring everything anyway. In terms of webinar, we'll have one webinar tomorrow by Oxpay. For those who are interested, just go into our Poems webpage. Next slide. Again, this is just our usual update on COVID cases. The good news is continues to climb to slide downwards. Next slide. So these are the cases out of Singapore. So let me just give you some highlights for the Ministry Task Force. They could not ease more than the market was expecting more significant easing of restrictions, but they couldn't do it because they said that emergency cases remain high and hospitalization is so high. So if you look at the red bar, you can see the number of cases still in the hospital, which continues to be a record number if you look at the red line. Nothing much, but I think the key takeaway for us was that they will make significant steps to ease and free up international travel. The timeline that they probably hinted was 3 to 4 weeks time. Next slide. Okay, we'll just run through two Phillip on the ground. These are briefings by analysts, but just to update everyone. So Top Glove is the largest glove manufacturer in the world. The results was really poor. The PATMI dropped from 2.8 billion to 87 million. So you can do the computations for you like more than 90%, more than a 90% drop. One of the reasons is the prices came down significantly, year on year at least. What's happening is China, they said that was increasing capacity very fast. I mean, these are just updates, cycles are shorter now. But what they think is that the oversupply may last maybe another 6 to 9 months. And and probably early next year, you will see a better balance of supply and demand. Again, these are just their own forecasts. Utilization is improving. Let me just run through to the outlook. I guess that's more important. So what they are saying is that they're beginning to see glove prices stabilizing. As in a way, buyers are stocking up, but a reason buyers are also stocking up is that they're also worried that as raw material price increase, so the distributors are looking to restock upwards because they're also worried that nitrile glove prices, rubber prices, and all prices are rising, and that could also raise the prices of gloves. But what is happening is that they mentioned that their margins or manufacturers' margins are still under pressure. Because of the intense competition, they've not been able to pass on higher costs. So most likely, the margins will still be weak in the following quarter. I think quarter-on-quarter earnings will probably be a flat, I would guess. I mean, based on what they said. Just that prices are stable, but they cannot pass on. Let me rephrase. Prices are stable, but cost is still elevated and they cannot pass it on. So they were just going to face a margin squeeze in the subsequent 1 or 2 quarters. Next slide. I'll just before that. I'll just run through RH Petrogas briefing. The fourth quarter. So RH Petrogas is an oil producer, and they have 2 onshore producing fields in West Papua. Again, it's a bit hard to see from this map, but it is in Indonesia and West Papua New Guinea. So if you look at the results, the earnings turn around from 1 million to 6 million, excluding one-offs. The production is up. So this company produces about 4,000 to 5,000 to about 4,007 barrels per day. They plan to raise it 4 to 5% per year. But you need to do a lot of work to maintain these flow rates of 4,000 because you need to inject chemical, to replace pumps. Otherwise, as usual, the natural depletion rate for any oil field could be around 8 to 10%. So if you don't do anything, your production will just drop 8 to 10% per year. Their cost is stable, it's about $30. What has happened is that they managed to control costs better since taking over from PetroChina as an operator. There was a bit of overhang on this stock, I think, until recently, where now their cash flows are better because as part of their agreement to extend their concession period, because they have these two fields in West Papua, Kepala, Burong, and Salawati, but to extend it, you actually have to commit capital expenditure. So they have a 68 million commitment to drill. But because at the time when oil prices were weak, there was a bit of worry they don't have enough funding. But I guess now they have net cash of 34, and with improving results, they can have enough to cover this commitment. Of course, the drilling cost is rather don't change. Yeah, the drilling cost is rather cheap because it's 3 to 3.5 million because this is onshore. So in terms of and it's only 1,200 meters deep. In terms of the prices, so for the whole of 2021, their price is about $70 US per barrel. They are quite close to Brent because they sell at a $1.50 discount to Brent. And they have a captive customer because all their oil is sold to Pertamina refinery nearby. in terms of the outlook, so we just did some rough back of the envelope computation. So if you assume $100 selling price this year, so we think that the incremental revenue is about 31 million. You have to use 220 working days. The PATMI may jump about jump to 30 million. This is again just our rough estimates, because we don't actually have coverage. But if you do some back of envelope numbers, this is the kind of earnings that they could generate in 2022. Anyway, just for everyone's reference, because there's only 2 oil and gas stocks in Singapore, Rex or RH Petrogas. Next. Next slide. Okay, this is just my last slide. This is just purely for reference. So we took at some of the numbers in terms of crude oil exports by Russia. So if you look at this chart, I think in 2020, Russia exported about 4.8 million barrels of oil per day. This 2020, they don't have 2021 yet. Most of it goes to China at 31%, and the rest goes to Europe. So the significance of this is that US may buy Russian oil. So you can see that US is only 55,000 or 1%. So it's immaterial. So it's very important that Europe doesn't stop, because Europe stop, then the whole, then it's going to be a huge shortfall in the whole crude market, because you're talking about, you combine Netherlands, Germany, you're talking about at least 1 million barrels a day. So if they were to buy Russian imports, then that will be a huge job to the crude oil market. And the other thing to note is also, as the title suggests, it's going to be hard for Russia to stop exporting, because they generate almost, just a simple rough is about almost 400 to 500 million a day by exporting crude. So if they were to stop it, they're going to lose a huge amount of money, because if you just take 4 million barrels and just times 100, you're talking about 400 million. The table on the right is nothing much, it's just to show you the kind of exports that they're doing. Even though it's down, but they're still exporting roughly 4.4 million barrels a day on a 12-month basis. Again, this is just for reference, so at least we understand the significance if there's any oil embargo and so forth, which countries are important. So US is not that significant in terms of not importing Russian oil. Again, this is just for everyone's reference. Next slide. That's the end of it. You can move on to questions.
For questions, I think I'll take the first question. I have one question. Oh, hold on, let me turn on my video. Sorry, give me a minute. Okay, so for my one question I have is that how many % of rate hikes have been priced into the 3 local banks? I would say it's 100 basis points. So it's, I think that's all I have for banks. I'll hand it over to my colleagues.
Hello, I will take the question on Del Monte. So any comment on Del Monte's third quarter results? Understand Phillips is the only broking firm recommending this company. Yeah, so thanks for the question. So maybe firstly, a brief quick overview on the results. So I guess what everyone is saying is that the bottom line, the PATMI, fell by 14% year on year, despite top line growth of 5%. So the main reason, the drag is from the US subsidiary, which is the Del Monte Foods, as they quoted higher, so the cost pressures, commodity prices, including higher tin prices, because for canned foods, you have to use, basically it's a huge proportion comes from the tin, and also freight prices, so higher ocean freight costs. And the management also mentioned that they are expecting this to continue into their FY23. But on a 9-month basis, we see PATMI up by 64%, and this is mainly due to the strong growth in first Q and second quarter of FY22. So apart from the results, the main reason maybe why we like this stock is that apart from the recovering profitability of the US subsidiary, comparing to the years when it was making losses would be its strong market positions in both US, under the US subsidiary, and also Philippines, so under the Del Monte Philippines. And this helps to ensure its pricing power. So if you refer to maybe our reports on Del Monte in the past, you can see that in Philippines, they have basically dominant market shares in key categories. So up to about 92% in this category, packaged pineapples, and 70 or 80% in the other categories. So quite a strong market leader in the Philippines. On the US side, in the key categories, also more than 20% market share, and is market positions wise is either number 1 or number 2 or number 3 for canned tomatoes. So you know, in view of the rising costs that are seen across all consumer companies, this helps them to ensure that, you know, they have the pricing power, so that when they increase prices, then this helps to protect their bottom line. So talking about price increases, the last time they discussed this during the results briefing was in the 2Q results release, and we saw, if comparing October and April 2021 prices, it was a 10% increase. And for 3Q, the management shared that they have actually implemented further price increases in the third quarter, but we'll only be seeing the effect in the next quarter, which is 4Q 2022. And that would be another 6 to 7% kind of increase. So we are expecting profitability to outperform that in 4Q21 if you refer to our forecasts. But of course, it's not all about price increases. The company, especially on the US subsidiary side, continues to place a lot of emphasis on innovation. So they shared that their target for this innovative products by FY23 would be this new products increased over the last 3 years to contribute about 10% to the revenue. Yeah, so that is all we have for now. So we will be releasing an update, and hopefully that provides more color. And we'll be
sorry, let me just add on. Since this was already mentioned in their briefing, maybe you can discuss, Vivian. Okay, so what has happened is that third quarter was weak year on year, but the thing is, there's a bit of a lag impact because they raised prices, but the profitability you only see the recovery, the rebound in the fourth quarter. But they did mention something on fourth quarter, right, Vivian, in the call?
Yeah, so on the profitability, which I also mentioned that we are expecting profitability to improve if comparing to 4Q21.
Yeah, because that's what they said. So in the call, and is in your website, they did say that fourth quarter earnings will be better.
Yeah.
Okay. Okay, let's move on.
Hi, I'll take some questions. Okay. First question is, despite strong performance in FY21, will ABSD rules impact CLI, CDL, and the residential market adversely? Okay, so for ABSD rule, first of all, it mainly affects Singapore citizens and permanent residents that are buying their second property onwards. That is when you see that there's actually a change in the ABSD. Also for foreigners and entities. So for foreigners, initially 20% ABSD has been raised to 30%, and for entities 25% to 35%. So for Singaporeans, while there is increase in ABSD, I guess another way around it would be decoupling. So for a couple to actually separate, put the first house under one name and the second house under another name. Apart from that, there might be a bit of wait and see, and eventually that might actually reduce the transactions in the meantime. So there might be a bit of a cooling effect as intended, which is obviously the purpose of this ABSD. For CLI, just do take note that CLI has already CLI is the entity that resulted after the restructuring of CapitaLand Limited. So there is no development business in CLI. So ABSD should not affect CLI at all. Yeah, so just do bear that in mind. Whereas CDL, yes, they're still very much involved in the residential property market. Okay. Yeah, I hope that answers the question. Another question that I saw earlier would be, sorry, let me scroll to the question. I think, sorry, I lost the question. Okay, to what extent do you think the performance of the property developers will be affected by rising commodity prices, for example, iron, steel, etc., or the shortage of such a commodity due to supply chain disruptions? So overall, depending on how long they hedge out their contract, from what we understand, the older, contracts that have been initiated or projects that have been started earlier on, if they have hedged only 50% of the cost, then there might be a increase in the later construction costs, and also depending on how much of the property has been, or rather the project has been sold. So if let's say a large portion of the project has already been sold, or if it's already 100% sold and it is only 50% in construction, then there might not be an opportunity for the developer to pass on this increase in raw material cost. As for new projects, there is still an opportunity for the developer to factor in these higher elevated prices while they are before they actually start to bid for the projects, or while they're doing their planning and the numbers to see whether or not it makes sense to go ahead with a project. They can still factor in an increase in construction costs as well as an increase in average selling prices. However, that being said, there might still be a little bit of margin compression. And overall, when we look at the whole Singapore property market, I think developers are cognizant that the rising land costs, the more competitive bidding for the land costs, as well as the higher construction costs, I think overall developers are more cautious, and they are also factoring in perhaps a thinner profit margin. Yeah. So the long and short of it is, overall, there might be a slight increase, and depending on how much they are able to pass through to the final buyer. And for new projects, likely this higher commodity prices will be priced in when it comes to bidding, and also it doesn't take away that there might be a tighter kind of profit margin. Yeah. Okay, I think that's all for me for now. I'll pass the time back to the rest of my colleagues.
Hello, let me take on a few questions on Adobe. First one was, what's the price to add Adobe, and do you see a target price for 2022? And in continuation, there was another question that, can you share more on competition, and what's their current fair price? So Adobe stock has actually fallen about 25% year to date, and this was not mainly because of any particular specific news regarding the company. The sell-off, it was mainly because of the sell-off and macroeconomic factors which dragged the stock down. So secondly, the outlook for the company looks promising. There has been significant demand for its products, and company boasts that about 90% of the creative media professionals, they use the Adobe's products, Creative Cloud products, and like Photoshop. And the company also said that about last year, about 300 billion PDFs have been opened by the users. And there has been significant growth in content worldwide, like anyone who is posting on a YouTube or digital companies nowadays, they prefer to be have a digital presence rather than a physical presence. So because of the digital transformation, the company's outlook looks promising. And talking about the competition in Creative Cloud segment, the company faces competition from CorelDRAW, then Canva and Getty Images. And in Document Cloud, the company's main competitor is DocuSign. Just to mention that DocuSign is still yet to report a GAAP net income. it has been reporting losses, and the company is expected to report a positive net income by year 2024. So to mention about the fair values, it would be difficult as we don't cover them right now. For Adobe, we have a target price of 658, which is about 45 to 50% upside from here. Yep, that's all. Thank you.
Okay, thanks. Let me just try to answer some of these questions. Hi, can we have a TA for STI index? Yeah, apologies for that. Our technical analyst, Weiren, has regretfully left the company, but we do have a separate session. I think if you go to Poems, you can sign up to a separate session, 8 p.m. Just on technical analysis. Yeah. It's a weekly, I think it's 8 p.m. every Monday. Yeah. So you can just go on, and then we have a technical analyst there that can address any questions. Or you can also join our Telegram group where we have a technical analyst there who can also address any questions that you have. I hope that answers it. What's your view on buying gold or shares of gold miners? Do they still have room to go up further? Again, this is just our own views. We don't cover gold, but I think obviously it's much better than buying gold miners. Gold miners, you still have to figure out what is inside the hole that they just dug up. You have to worry about costs. You have to worry about their production and so forth. Whereas you just take a position in gold price. I think that's GLD ETF. I think that's probably a easier way to play than just to try to understand individual gold miners. In terms of price, a bit surprised that it didn't move out higher than expected. You just had a war, and the price was only 1,007 to 2,000. So this one always I rather not touch it, because it's just unless you have a clear direction where this war is or conflict is heading to. My own thoughts is just I would rather avoid it. I mean, just my own thoughts, because we already had the war. I think it was meant to be a hedge for conflicts like this, but since we already had it, you already have this. The event has already kind of have already materialized. So I'm not sure I don't know what's the purpose of having the goal now, because it's already reacted to the conflict. Again, this is just my views. I'm sure there's a lot of pushback to that, but I mean, this is my own thoughts. Is it likely for Asian pay TV to be privatized? It is unlikely. Firstly, media companies are very highly regulated in Taiwan. Even trying to buy, if you can recall, Dada Digital, which is one of the major shareholders now, tried to buy a stake in the trustee, not even in the operating entity. The trustee of Asian Pay TV Trust was also rejected. So imagine trying to privatize this. The regulatory authorities there are very nervous when anyone takes control of media assets. Yeah, so we think it's unlikely on the regulatory front, and of course there's also debt. Although they pay 7%, you do know that there's leverage on this company. So whoever takes it on also have to take into account the leverage. So I don't think a privatization, although there was rumors, I think 2-3 years ago, we think it's highly doubtful. Even then and also now, I don't think they would be privatized unless they have some scenario where they think the backhaul revenue is going to be so huge that it's worth privatizing. But unless they have that assumption, for us right now, I don't think it would be a privatization candidate. What's your view on SQ? I'm not sure whether Terence can help on this one, but okay, let's move on to the next. Paul, for the new dental clinics, do they have a gestation or break-even period? The usual gestation, I know there's another question, is the financing. So to open the clinic, the two biggest hurdles is, of course, finding a dentist. So that's always the toughest part. And also, because if you're talking about 30 clinics a year, you at the minimum need to hire at least 60 dentists. So that's why they have a big team now to do all the recruitment. The second bottleneck is getting a good location. So if they don't hit their target, it's mainly because they can't find a good location. Gestation period, 6 months or a year also can you can break even. The reason why I say this is because the cost to set up in Singapore, of course, Malaysia is cheaper, but it's probably, I think, 100,000 to 200,000, and it's purely equipment. And that's at the high end. I'm really like stretching the, because it's not expensive to open up, because you just have to buy, I'm just kidding, it's not elaborate, you're not buying a MRI machine, you're just buying a few chairs and a few equipment and you're ready to go. Because most important is the dentist. Your asset is the dentist, not so much the hard equipment. That's why the break even can be quite fast, depending on the ability of attracting patients. So that's the most important. Because just a refresh, I mean, half the fees collected actually goes to the dentist. So they will collect what the dentist collect, half, they will take half of it, and the balance half goes to the dentist. But of course, that half goes to pay rental, pays the nurse, pays whatever back office support that they give. Yeah, so, yeah. And just to give you a rough idea. Okay, let me just run through again. How does Q&M intend to finance its opening of new clinics, by debt or yeah? I think their net debt is probably about 40 million. So if they generate maybe 20 million cash, they can use it to fund cash. I mean, it's depending on how much dividends they want to pay, so they can fund the expansion. Are they literally opening new clinics or acquiring the existing ones not under the dental chain? Yeah, they are actually opening new clinics. I think from their experience, buying new clinics is not worth it. I think that's what they did. I think when they IPO'd, I can't remember, probably 2006, I think, just off memory, probably wrong, but they were doing this major acquisition path and the share price did very well, but then they realized it's going to be very expensive to acquire, and it's much cheaper to start up a new clinic. So all these new clinics, they're no longer acquiring existing clinic chains, because they realize the payback isn't there. It's not worth it, because you're paying upfront for all the profitability of these chains. Whereas as you start up, it's only 100,000, 200,000 for one clinic, rather than a couple of million for existing one. So the maths is better, but of course, it makes it a bit slower. You won't get the immediate profit contribution. But at their size, I think, and the branding, it'd be better to do a greenfield. What's your view on oil price, and is it a good time? Okay, I'll give you my 5 cents view. The problem I have with oil price is that, of course, we all know there's a conflict. I think the issue is also, has supply really been permanently damaged? So right now, supply hasn't really been permanently damaged. If you look at Russia, it's just that people don't take the oil, but the supply is still there. That's my only pushback I have. That's my only worry, that the supply is still there. It's just that there are sanctions there. So anytime you have a good piece of good news, you can see the huge reversal in the trend. So I'm just a bit wary of playing the oil price, because it's a daily news cycle. So it's like a high stakes gambling, because it's one day up 5%, one day down 5%. So it's a bit too risky for us. Is it better to enter REX? I'm not that familiar of REX. But the only thing, at least for RH Petrogas, the only reason I like it is just that it's onshore and it's cheap. I think their cash cost is about $30. So even though oil price dropped back to 90, they can still drill profitability. And onshore, there's less risk, of course. I think REX is more offshore. So again, this is just my own thoughts. I mean, we don't really cover. I'm just sharing whatever we have. Okay, why is Raffles Medical going up? I think there's a bit of bounce in Raffles Medical. I think if you listen into the ministry task force, I think what they said is that they are shifting some of their patients from public hospitals to these CTFs, COVID treatment facilities. It used to be basically the utilization of these COVID treatment facilities, like those in Expo, was only 10%. Basically, there's nobody going there. But right now, they've actually transferred a lot of even non-COVID patients to these CTFs. And these CTFs are actually run by private healthcare operators such as Raffles. So maybe that could be one of this incremental news flow that might have helped them. Yeah. I think this came out on Friday. If you listen into the ministry task force, I think the MOH is shifting. So their utilization for These CTS jump from, I don't know, 10% to 50, 60% right now, or even more. Yeah. So that might help Raffles because they are the ones operating some of these in Expo. Okay. I think the rest. Okay, let me just answer this before I hand it back to the rest. Can you mute? Who's on the poems? Can you all mute it? Hi, Paul. What's your view on QMCO taking? Sorry, I can't comment this. This is his personal stake. Yeah. I think once they're more settled, maybe he just bought it because it's very cheap. But very unfair to comment on this because it's more of his personal stake. Thanks. I think I'll move on to the rest. Natalie, can you help out some? Thanks.
Hi. Okay. Sorry. Just now earlier I saw a question on Tasin. I'm gonna read it out. What's your latest update on Tasin? Group to nibble. Okay. So for Tasin, overall, I think the revenue for FY21 grew by 15.8%. This was mainly due to contribution from two of the newly acquired malls, Shunter Metro Mall and Taipei Metro Mall, which were acquired in July 2020. And also, of course, higher revenue from Shiqi and Ocean Metro Mall and Tasin E-Color due to recovery from COVID as well as lower rental rebates given. That being said, our main concern with Tasin is their snowballing debt. Initially, I think about 500 million of it was actually the loan, the amount that they needed to refinance. However, it has been instead of getting a refinancing, they were only able to secure extension of the loan. So it has been extended 2 times, and now again 2 or 3 times basically, and now it's adding on another portion of the loan that will be expiring in 2022. So that brings the total maturity for this year to about $730 or $740 million. So in our view, that is actually quite concerning. And just want to mention also that all of their assets have been mortgaged, or rather these loans are actually secured loans, meaning that their assets have been pledged. So if anything does go wrong, if they're unable to secure the refinancing for these assets, Tasin will not be able to sell the assets because these assets rightfully have been pledged to the bank. So if anyone were to sell it, it would be the banks and not Tasin. Yeah. So that's one thing that is a bit concerning. So when the management was asked about what happens if the loans are not refinanced, then they broadly gave three scenarios or 3 solutions. Firstly, it would be raise external debt from the market or from majority shareholders. Secondly, would be internally generate funds, which, as mentioned, this is not possible because they cannot sell the assets as it already has been pledged to the banks. And of course, rebalancing the assets, which means to sell the assets and then the proceeds will go to the lender to pare down the loans. Yeah. So overall, this snowballing debt is one of the main concerns. And also these facilities, the refinancing for the facilities are actually due on the 20th of March, which means in another 6 days time. Yeah. And in our view, this is quite worrying. Maybe to put things in a bit of perspective, when we're looking at the NAV for Tasin, it is currently at $1.40 per share. And if you look at the share price of 33.5 cents, meaning 0.335, that actually means that Tasin is currently trading at a price to NAV of 0.24 times. Yeah. But overall, I think our view is this: we really do not like the situation with the refinancing. So we recommend that we have no coverage of Tasin, and we recommend that you would stay out. Okay. There's some questions about Prime. Sorry, let me look at my notes and I'll come back again about Prime.
Yeah. Okay. Let me just try to take on some. Okay. Sorry. Give me 1 minute. Okay. Many thanks for hosting the most lively SPH. Yeah. I think thanks to SPH investor. Thanks to Terence, who was the moderator there. Would you opt for cash only or cash and SPH REIT? Again, these are all my thoughts. I mean, maybe Terence can share, but I think that's the opt for the cash. If you want, you can just take the cash and buy the SPH REIT. Of course, there's a bit of a discount there, but I mean that you are maybe paid a bit more with the SPH REIT. But again, you're not sure how SPH REIT will perform, because there'll be those who opted for SPH REIT might also opt to sell it. So my own thoughts, I mean, is just take the cash. If you want, you can just take the cash and just buy the SPH REIT yourself, because you're also unclear if you are going to get that pricing. And I think the pricing is already, if you include the option, it could be even below the current price. Yeah. So my own thoughts is just take the cash. Would be like, yeah. Okay, there's high power, the gold ETF that can use CPF. Again, I have no idea. I just did a Google search myself, but there is a GLD listed on the SGX, and the GLD ETF that's listed on SGX, and that is under the CPF investment scheme. So that's allowed. That is, the GLD actually holds physical gold, so it doesn't actually buy miners. But again, you can just do a quick Google GLD and CPF, and you get the answer there. Yeah, I hope that helps. Even if the war is to end now, inflation is still likely to continue for some time, hence the relevance of gold, I feel. My thoughts, again, that is also true. Again, I'll just give you the two views, okay, for gold. So if interest rates, if inflation rise and if interest rates increase, there could be some flows. The liquidity might flow away from bonds and go to gold. Because you're going to lose a lot of money on bonds, right, if interest rates. So you might get that benefit. But ultimately, that should, I mean, on paper, reverse, because gold is still like a zero coupon bond. That means probably the worst bond to hold. But for the meantime, to avoid being losses, that gold could actually enjoy the flows. But if interest rates keep on rising, then it would be better to own bonds eventually, because they're going to pay you something in return rather than gold. Again, I mean, everyone can debate this, but again, these are just my own thoughts. Yeah. That's why I actually thought gold would rise, because even before the conflict, because there could be some liquidity flowing, people don't want to hold bonds, so they end up going to gold. But I guess that didn't happen. You had to take the Ukraine conflict. Again, everyone can have a different view, yeah, and rightly so. Okay, and Natalie, I'm not sure if you can do the Capital REIT one. Any news on Oceanus? Sorry, I don't really have it. We'll try and get them for webinar, but we did had them last year, so end of last year, so we'll probably wait for a couple more months before we get them. Yeah. They don't do any briefing, so sorry, we can't really give an update. Yeah, I think the rest is probably yours, Natalie, and maybe Terence, if you've got any news.
Yeah, I'll probably take some of the questions in the queue. In your view, what is the impact of the Russian invasion on counters like SQ sets? So we got no coverage on both counters, but probably let's comment based on our following of SQ and sets. For the in terms of the impact, there's very little impact on the counters like SQ and sets, because for sets, the most important metric that we are tracking is the throughput at Changi Airport. So that is the most important indicator for sets. If there are other things that they are tracking as well, but if the number of passenger traffic in Changi Airport is low, then that will put a cap on their earnings. So if you look at the January 2022 passenger volume, this has increased about 4 times the passenger traffic at Changi Airport has increased 4 times compared to 2021. So when you compare January 2022, it's a significant improvement from last year. And it's still about 80% below what it was pre-COVID level. So we still have a very long way to go for there. But what we've seen is a significant improvement in the throughput in Changi Airport, and that is positive for SATS. And then the recent Russian invasion actually has not caused such a big dent on their passenger volume. But in fact the new vaccinated travel lanes that they announced with Australia and Malaysia, those have actually driven volume quite significantly. Yeah, let's continue down. What are your views on the proposed sale of SPH to Cascaden? So for Cascaden, they are when I think the directors for SPH agree that the Cascaden offer on the table is significantly better than Keppel. So they have actually recommended shareholders to vote in favor of the Cascaden deal as opposed to the Keppel deal. So this amongst the options on the table, after going through a very competitive process of looking for different buyers, the Cascaden deal was the most compelling for shareholders. So it seems like at this moment, at least, that's the best outcome for SPH shareholders. We have one more question from Hifu. Sam Marine, is merger with Keppel O&M unit, does it benefit Sam Marine or Keppel Corp more? Do you see value in Sam Marine here in your view? So I think the first question, for Sam Marine and Keppel Corp, they are trying to work on a mutually beneficial deal for shareholders. So the impetus for the merger for these two units is that it is not, especially in an environment, especially in the last few years where oil prices have been very low, it does not make sense for them to be competing in the market for the same contracts, and sometimes they do find themselves competing against each other for these contracts. So what they have seen is that if they can merge their units together, like what the Chinese shipyards do and the Korean shipyards do, they can get more revenue synergies and also some cost synergies. Obviously, the cost synergies are easy to see because they can merge their units together, and when they merge their units together, then they will be able to realize cost savings for the yards. So they haven't announced the deal yet. We expect an announcement in the next few weeks. We know that they're trying to tie up some of the loose ends, but they haven't announced the deal yet. So we cannot comment on who it benefits more now. But what we do know is they try to work on a mutually beneficial deal. There's a second question. Do you see value in Sam Marine here in your view? So yes, because a bigger Keppel O&M, when you strip out some of the impairments, is already profitable already for Keppel O&M. In fact, in their full year 21 results, they were actually EBITDA positive. So and net, in terms of net loss, the net they were only making losses on the net profit level because of some impairments. Otherwise, the O&M unit is actually profitable. So that we see value, but until they announce the deal, that's all we can comment on right now. Yeah, okay, that's all for me. I'll hand over the time to the rest of my colleagues.
Okay, some of these we apologies, we can't help you on some of these because these are Hong Kong stocks, and even if we tell you, we don't follow, and we probably give you the wrong answer. Like, can you comment on Tencent, Alibaba? Yeah, apologies, we can't help you on that. You probably don't want to know our answer is probably wrong. Should we exceed on HS Tech? Yeah, again, sorry, we don't really have much comments on that, or even the EV like Neo. Apologies again, we don't cover, so not much value add that we can give. So better not to say anything. I think most of it is for Natalie and also for Glenn, if you have. Yeah.
Yeah.
Um,
I think, can I take that one question for the banks first?
Yep, go ahead.
Okay, sure. Thanks. CL asked, do you think Singapore banks have bottomed? In my personal opinion, yeah, I would say so. And they have actually all three banks have started to recover from the bottom a few days ago. I think a week ago, yeah. So, I mean, things are looking up for banks because, their allowances are going down, and they have interest rates hikes to look forward to, as well as their non-fee income is also growing as activities pick up. So everything looks to be very bright on the bank side. So I think they will just recover stronger from here on out. Okay, so I hope that answers your question. I'll hand over to Natalie now. Thanks, Nat.
Thanks, Glenn. Okay, I'll take the question on, can you comment on Prime US REIT? Why is it performing quite poorly? Overall for Prime US REIT, hold on, now I've moved away from my Prime. Okay, sorry. For Prime US REIT, overall, their DPU actually dipped slightly, 2.3%. This was due to the enlarged share base post EFR. So they had to undertake an EFR to finance the acquisition of Sorrento Towers and One Town Center in July of 2021. So this is a little bit unfortunate, given that Prime actually benefited from a very strong positive rental reversion in 2021. So positive rental reversions came in at 15.8% for Prime. Yeah. Overall, I think for the US office REITs, Prime, Manulife, as well as Capital Capital Pacific Oak, we see that the share price has actually dipped across these three REITs, more significantly so for Prime as well as Capital in the last few months. I think overall this is still indicative of the rising interest rates more than anything else. Yeah. So in the last week, yes, we see that the Prime's share price actually has dipped by about almost 10% in the last few weeks. Yeah. And I think that's quite similar to what we are seeing with Capital KBS also, about 10% down. Yeah. So I think it's not just Prime alone. Okay. The next question would be thoughts on why Lendlease Global REIT is so-called tanking. Market does not appear to like the GEM acquisition. So overall, I think for the GEM acquisition, because this time round, initially they've already acquired about 28% of GEM, and the earlier tranches of GEM was actually financed using debt or perps, and of course the debt and perps, they actually carry a very much lower cost of capital. And this time around, the remaining tranche is quite significant quantum, about 1.7 billion kind of price tag that is coming with this acquisition. And because of this, sorry, is it 1.4, 1.7? Yeah, so it is relatively significant. Yeah, and because of this, it actually necessitates equity fundraising, and that of course carries a much higher cost of financing. Overall, making this this tranche of the acquisition less accretive. So according to the pro forma numbers, the accretion is expected to be about 0.1% to 3%. Yeah, and based on our own forecast, we're actually also forecasting a 0.1% accretion, which is actually very small. Although this asset GEM is in our view quite a good and stable asset. Yeah, so I think largely is because this acquisition is a bit less accretive than what the market would like it to be. Otherwise, the share price it was actually holding up quite well until recent weeks, where okay, just do take note that when they did the EFR, the price that they actually gave the market, or they indicated